Hi, this is James Eng with Old Capital, and today I'm going to be talking about Fannie Mae loan assumptions. We're going to give a little intro on Fannie Mae loan assumptions, advantages, disadvantages, and then walk through two case studies so you can just sort of see real life why this matters and how investors can make decisions. So a little bit about me. I was born and raised in Houston, Texas. Went to school at UT Austin, did finance there. Lived in Dallas Fort Worth since 2006. So after UT, went to work at GE Capital, where I was an underwriter for close to 8 years, underwriting over 750 million in commercial real estate properties all throughout the U.S. In the last 5 years, I've been really focused on multifamily. So originated over 750 million in multifamily loans across 125 different properties. And then I also invest as a limited partner, currently across 21 properties, 6,000 units in Dallas, Fort Worth, Austin, and San Antonio. So in total, about 1.2, 1.3 billion in commercial real estate transactions, and then also as an investor. So why do Fannie Mae loan assumptions have to occur? So let's go through it. So typically Fannie Mae loans are typically 5, 7, 10, 12 years with a balloon at the end of the payment maturity. And since these loans are fixed rates, they guarantee the investor who buys that loan a fixed payment for the entire loan term. And so if you take out, let's say, a 10-year loan, which a lot of people did in 2016, 2017, and so your maturity is not till 2027. Um, if you call your Fannie Mae lender and say, hey, I want to prepay this loan, there's a prepayment penalty, and it's called yield maintenance. And this can be anywhere from 10%, even up to 20, 25%. We're going to go through some case studies where this is quite large, depending on your current interest rate versus the prevailing interest rate in the market, and then also the remaining loan term. And so if you have 2 years left to maturity, the prepayment's not going to be that high. But if you have 8 years or 10 years left on the maturity, it's going to be significant. And so when sellers go to sell their property, they have to take this into consideration. And so if you can, as the buyer, assume the first mortgage, then you can get a lower price. So for an example, let's say they offer a new deal, $10 million on the loan assumption. It might be $11 million on new debt. So $1 million of a yield maintenance penalty on the Fannie Mae. One of the things that makes it a little bit easier to do the loan assumption, though, is supplemental loans. And so Fannie Mae has a very unique characteristic where they can actually add a second loan to that original loan. And so Fannie Mae loans with at least 5 years until the loan maturity is available to new buyers at acquisition up to 75%. And then it's also available for the existing owner after 12 months to get cash out up to 70%. But the one thing that typically trips people up is the debt service is constrained at 130. And so what that means is your NOI divided by your debt service needs to be a 130 cover, whereas on new loans, it is typically 125 for Fannie Mae. And you as the borrower can only get one supplemental. So it doesn't really matter how many supplementals are placed on a property. It is one per borrower. And so if you get it at acquisition, that is your only supplemental. But if you buy the deal and then or assume the loan, and then let's say 12 months or 24 months down the road, you want to add that supplemental, you can, but you have to watch out for the 5 years until maturity. And the cost on supplemental loans are typically 75 to 100 basis points higher than the prevailing market rate. So let's say prevailing market rate today is about 4%. And then you would add 100 basis points to that so about 5% on supplementals right now. And then it is a new loan. So there are legal costs, third-party costs associated with it. And so let's talk about some of the benefits, disadvantages of loan assumptions. Number one benefit for you as the buyer, you get a lower purchase price as the seller doesn't have to pay the big prepayment penalty, typically yield maintenance. And number two, your interest rate on the existing debt might actually be lower. than the current market rates. While most loan assumptions right now, the rates are anywhere from 4% all the way up to 5%. But in today's market, interest rates are actually pretty low. And so we're locking rates at anywhere from 3.6 to 4%. So that benefit is not there right now. Um, Disadvantages of loan assumptions typically, your leverage on a loan assumption. So the loan assumption plus the supplemental can only go up to 75, whereas new debt, if it qualified based on a 125 debt service, you could go up to 80%. Number two disadvantage is there's no interest only left on the loan typically. So most people, they get anywhere from 1 to 3 years of interest only on their existing loan back in 2015, 16, 17. And so that usually has burned off by now when they go to sell the deal. And so it's amortizing day one. And so a lot of times your cash on cash is lower. Number three, limited loan dollars available for rehab. So on new debt, most of the time people are rolling in their rehab. But if you are constrained at the 130 debt service coverage, it is typically difficult to get that rehab rolled into the loan. So you have to raise more equity. Number four, you have to use the existing DUS lender. So if it's Wells Fargo, you have to use Wells Fargo for the loan assumption, the supplemental, and then the asset management. So a lot of people have a DUS lender that they like to use. But if you do not have a relationship with that lender, and now you have to use a new lender that the previous seller used and do the assumption supplemental, that can actually be very difficult because every DUS lender is a little different, and you have to learn sort of how to work with that particular lender over time. Number five, existing loan term might not match your investment horizon. And so if you look at a loan that has to be assumed and it's a 10-year loan and it's still, and you want to sell in 2 to 3 years, you're still going to have that yield maintenance penalty. Or the loan might barely have 5 years left to maturity. And so maybe it's, 5.5, 6 years left to maturity. And you think, hey, the recession is going to come up. I want a little bit longer runway. I want 8 years or 10 years left. Then that might not be the best time for you to be out trying to refinance your Fannie Mae loan in 5 years. And so that existing loan might not match your investment horizon. And the sixth disadvantage is it's a longer time to close. And so the loan assumption supplemental process goes through really their asset management group and not their new origination group at these DUS lenders. And they are a little bit slower. They're typically not as, keen on getting you closed in that 45 to 60 days that a new origination team would. And so those are the benefits and disadvantages of loan assumptions. So I wanted to walk you through some case studies because I think that's the only way that you can really understand these loan assumption supplemental decisions. And so I wanted to show you, this is an 80 unit deal in DFW. And really the broker is going to bring the deal out. The purchase price is 7.5. You have to assume the first loan, the assumption, or 8.5 on new debt, because there's essentially $1 million yield maintenance penalty on this deal. And so for the seller, they can take this deal either way. They don't care which one you choose, the assumption or new debt. Their net proceeds are going to be the same either way. So let's look at the option one loan assumption as a buyer, right? So the existing loan is $4 million at 4.5%, which is a good interest rate. 8 years left to maturity. Okay, so good enough runway. And then the supplemental that it's currently qualifying for is 1.3 million. Okay, so you take the 4, 1.3, and we've assumed that supplemental at 5%. So based on a 130 debt service, you can add 1.3 million of a supplemental loan. So your total loan is 5.3, and it's about 71% loan to value. No interest only left in the loan, and 30-year AM thereafter. So it's going to be 30-year AM day one when you walk into the deal. All right, let's flip over option two. So new debt. So 8.5 million is now your purchase price. The new loan of 6.3, we're assuming about a 3.75 interest rate, so about 74% LTV, which is good. 3 years of interest only and 30-year AM thereafter. So let's look at, okay, so what does that mean to you as the investor? So let's go into option one. So if you have a $7.5 million purchase, loan of 5.3, that's 2.3 million in equity raise that you have to do, plus your rehab. And then so your cash on cash, just based on that equity raise, is about 6%, and your IRR is 15%. Flip over to option two, you buy the deal at 8.5, $6.3 million loan, and you have the 3 years interest only. So now you raise about the same amount of equity, $2.2 million in equity, but your cash on cash year one is close to 10%, and your IRR is only 13.5%. So you're saying, why is my cash on cash better in year one? Number one, it's interest only. So you have 3 years of higher cash on cash, but your internal rate of return is only 13.5. And that is really driven by the next 5 years of cash flows and your residual sale. That takes into consideration all those things. And what happens is you get the 3 years of interest only, but typically you're going to have a new Fannie Mae loan that someone's going to have to assume, and you're not going to get as high of a price when you go to sell as the person in option one. And so what you have to really figure out is, are your investors more cash on cash driven or IRR driven? And that will make your decision on whether or not to take the loan assumption or the new debt in this first case study. So let's do one more. This is a larger deal, 130 plus units in DFW. Purchase price on the assumption is 12 million. On the new debt, it's 14.5. So this one has a larger prepayment. So $2.5 million yield maintenance prepay. Existing loan on the loan assumption, 6.75 at 4.58, but there's 10 years left to maturity. And so this deal was recently, this loan was just put on about 2 years ago. It has 10 years left to maturity. Supplemental loan only qualified at about 1.2 based on the 130 debt service, which we talked about. So you're only at 66% at purchase price, no IO left, and 30-year AM day one. Option two, the new loan was 9.3 million at 3.75, so 64% LTV, but you get the 3 years interest only and 30-year AM thereafter. So let's look at this one. So in bold, I sort of put in, all right, so when you're as an investor, option one, you have to raise $4 million. Your year one cash on cash is 4%, but you do have a higher IRR, 13.5%. Option two, even though you are getting the new debt, the yield maintenance penalty of $2.5 million is making you pay $14.5 million for this property. And so you're having to raise $5.2 million in equity. Your cash on cash is slightly higher because of the interest only, and your IRR is 12%. So in this consideration, because the cash on cash is not that different and you would have to raise that amount of equity, most people in this situation would go with the loan assumption. So I put some questions here to ask as you go through this process, because it is not, it is a little bit more complicated than just a straight new debt. So you need to understand, what's my loan amount on the first mortgage, interest rate, also how much term is left, right? So can you even add a supplemental, because you need that 5 years left to maturity? What's the current prepay on the yield maintenance? Number four, is there any interest only left on the current loan? Who's the existing Fannie Mae DUS lender? Do I want to work with that DUS lender, or is that someone I had trouble with in the past? What's the current supplemental loan amount and interest rate? Because think about it from the lender's perspective. They have an existing loan of, let's say, $5 million, and now you're saying, hey, I want to come back and add another $1 million or $2 million to this loan. And so that is higher risk. And so some Fannie Mae DUS lenders don't like that. And so they're going to underwrite the deal a little bit more conservatively, and your interest rate is going to be higher. Number seven, how much equity do I need to raise on this loan assumption supplemental? And will people like that cash on cash? Because it will be lower, especially if you do not have the IO. Number 8, what's the leverage on new debt? And so as interest rates move around, like right now it's 3.75, as interest rates move around, that leverage might go higher and higher and higher. And then if Fannie Mae gets more aggressive or more conservative on IO, what do I get? Number 9, this is the big one. I mean, how much equity do I need to raise? And some people, especially as loans and properties get bigger, it becomes a lot harder, especially if you're buying like a $25, $30 million deal. That equity raise portion, if you can't raise that equity on the loan assumption because it's a lot higher, then you're going to have to go with new debt a lot of times to get the higher leverage. And then number 10, I think this is probably driving a lot of times that total return, that IRR is not dramatically different, loan assumption versus new debt, but the cash on cash is. And so if your investors are focused on cash and you just can't raise the money with a 5% or 6% cash on cash on the loan assumption, then you're most likely going to go new debt. So next steps, subscribe to the YouTube channel if you like this content, like the video, and really to take it to the next step and really get focused is to complete a personal financial statement, set up time to talk with me. We can do that via email, set up a phone call from there, and then start underwriting new deals. Because as brokers put out new deals, they're gonna give you two prices, one for loan assumption, one for new debt. And then you have to start underwriting these deals and figuring out which is a better way to take these deals, loan assumption or new debt. And then really just sort of make offers, start building your resume, partnering with people, and close the deal. And so to see all my loan closings, you can go to www.texasmultifamily.com. That's again, texasmultifamily.com. Thanks a lot, guys.